Hi guys, my name is Sarvan Kumar. I am your economy faculty. Welcome to Rathod's IAS Economic Weekly Series. As usual, even this week we do have a lot of economic current affairs which appeared in different newspapers. So without wasting any time, let us look at the first topic. Okay? See, the first topic that we are going to discuss today is about the GST compensation cess extended till 2026. So we will discuss this topic in entirety. Okay, see, we will start first by discussing the basics. Everybody should have a clear idea with respect to what is the difference between a cess and what is the difference between a surcharge. What is the difference between a cess and what is the difference between a surcharge? Both cess and surcharge are nothing but taxes on tax, right? See, both cess and surcharge are of same nature. They are like tax on tax. They are imposed on the tax, right? But the cess is collected for a specific purpose and the surcharge is not collected for a specific purpose. Let me give an example. See, imagine the price of a good is 100 rupees, and if the government says the tax on that particular good is 10%. Now what is the 10%? Of this particular 100 rupees, it is 10. Now what is, see, for example, if the government says cess is 10%, what does it mean? See, understand, the tax is 10%, which translates to 10% of the 100 rupees is nothing but 10 rupees. Cess is 10%, which is nothing but 10% of this 10 rupees, which is nothing but 1 rupee. So totally the shopkeeper will collect from us the 100 rupees, the 10 rupees tax amount, and he is also going to collect that 1 rupees. Totally he collects 111 rupees, and that 1 rupee is called cess amount, right? I hope it is very clear. Similarly, the surcharge is also going to collect in the same way, but cess is collected for specific purpose. It is being collected for specific purpose, right? See, Swachh Bharat cess, education cess, GST compensation cess. So whatever the name, whenever you heard the term cess, it would be coming up with an addition like education cess, Swachh Bharat cess and GST compensation cess in such a way. So for the purpose, say for example, the government is collecting education cess. Now the cess amount collected in such a way should be completely utilized for the promotion of education or for the purpose whatever it is collected for. Right? I hope it is very clear. And surcharge is going to apply in a similar way, but the government is going to use it on its discretion. There is no specific purpose for which the surcharge is collected, and cess is collected for a specific purpose. So I hope you understood the difference between cess and surcharge. Cess is tax on tax, surcharge is also tax on tax, but cess is collected for specific purpose, and such collected amount should only be used for that purpose only for which it is being collected. And surcharge is not collected in such a way. It can be used for any purposes. So this is the primary difference between cess and surcharge. Now, let us try to understand what is this GST compensation and each and every detail. See guys, in the previous classes, in the previous economic weekly series, we have clearly understood how the GST is going to work in the economy. How the GST is working in the economy. We have clearly understood that GST is currently working in the same way in which the VAT method is worked, once in the country, once in the states particularly, right? So we have clearly discussed about the working of the GST, and we have discussed in detail in many economic classes. So we are not going to discuss all the working of the GST and each and everything in this class, but particularly we are going to discuss this GST compensation cess and what is this current affair is all about. Okay guys, see, when we have a basic context, just have the recap of what we have discussed in the previous class. See, the central government, before the implementation of the GST, the central government imposed different kinds of indirect taxes. One of them is central excise duty. What is a central excise duty? Central excise duty is nothing but it's a tax imposed on the production of goods and services. It's a central excise duty. Now, the states are also used to impose different kinds of indirect taxes like sales tax, the state's excise duty, right? Luxury tax, the local bodies octroi, entertainment tax, right? Entertainment tax, amusement tax, In such a way, the state governments have imposed different kinds of indirect taxes once. Now, all these taxes are first amalgamated into the state VAT, right? All these amalgamated into the state VAT first, and then it is converted to SGST, right? So in such a way, the major part of the CGST that we are currently seeing is nothing but the central excess duty, and all these indirect taxes of the state governments have amalgamated in to create the SGST. In such a way, we have the CGST and we also have the SGST. Combinedly, we have the GST. In such a way, the GST is being, right, came into force. You all know that the GST have come into force from July 1st, 2017. It came into effect from July 1st, 2017. Guys, here you need to be observed very carefully. You have to observe very carefully here. See, these are the indirect taxes. These are like different indirect taxes the state government have imposed on goods and services, right? Try to understand. The states, see, we have understood clearly about the GST in the previous classes. Now, how the GST is going to work? GST is a destination-based taxation. GST is a destination-based tax. Now, what is the meaning of destination-based tax? Say, for example, a good is produced in the state of Tamil Nadu and it is being sold in the state of Punjab. It is sold in the state of Punjab. Now, see, earlier what used to happen before the implementation of GST, if the good is being consumed in the state of Punjab, say, for example, a tire, right? A Madras rubber factory MRF tire is being produced in the state of Tamil Nadu and it is being sold in the state of Punjab. Now, we are talking in the context of before implementation of GST. Now, the tax amount on that particular tire paid by the consumer will be going to the state of Tamil Nadu. Say, for example, he is the one who purchased the tire in the Punjab. That tax amount is being given to the state of Tamil Nadu, right? Now, after the implementation of the GST, you know the GST is nothing but destination-based taxation. GST is going to be implemented as a destination-based taxation. We have clearly discussed about the features of this GST in our previous classes. Now, if the Tamil Nadu, see, the tire manufactured in the Tamil Nadu is sold in the Punjab in the GST regime, the tax amount collected on the tire will be given to the state of Punjab, which means wherever the good is being consumed, the tax amount on that particular good will be given to that particular state in which the good is being consumed. So that's the meaning of destination-based taxation, which we have clearly discussed. So the states are going to clearly accumulate the losses in such a way, right? Isn't it or not? See, you have to observe these two things. On one hand, the states have sacrificed their power. The states have sacrificed their power to impose different kinds of indirect taxes on the goods. So more after the implementation of the GST, these particular taxes are being given to those states where the goods is being consumed. So these two reasons have triggered many states to raise the concerns about the GST. These two reasons, particularly these two reasons, have triggered many states. Like, see, understand, imagine I am from the state of Tamil Nadu or I am from the state of Andhra Pradesh or Telangana. Now, what happens after the implementation of the GST? Two things happens. Before the implementation of GST, I do have a different powers. I do have a power to impose different kinds of taxes on goods and services so that I can have my own state tax revenues. Now, after the implementation of the GST, all these powers to impose different kinds of indirect taxes have been sacrificed to implement the SGST, isn't it? Now, the second one, once the GST is implemented, the tax collected will be given to those states where the good is being consumed. It is not being given to the state in which it is being produced. So, due to these reasons, many of the states have raised the concerns. Now, the central government, so see, what they have said is, if you implement the GST, okay, in order to implement the GST, we will sacrifice our power to impose different kinds of indirect taxes, right? Now, what if we accumulate the losses with the implementation of the GST? Now, in order to compensate the losses of the state governments, the central government enacted GST Compensation Cess Act of 2017. What simply central government said is, see, you have sacrificed your power of imposing different kinds of indirect taxes to implement the GST. It's okay. It is accepted. Now, whatever the loss you are going to get with the implementation of the GST, we are going to compensate it. This is what the GST Compensation Act says. Now, try to understand. In order to compensate it for the states, the central have created a GST Compensation Fund. GST compensation fund. The center have created the GST compensation fund. Imagine this as a GST compensation fund. Right? Now try to understand, guys. Try to understand. Now, when we discussed about the GST, we have discussed about the GST slab rates. We have discussed about 5% slab rate, 12% slab rate, 18% slab rate, 28% slab rate. See, try to understand. All those items, like particularly those items which comes under the 28% slab rate, upon those items, the GST compensation cess would be levied. Right? Say for example, there is a good and these good comes under the GST slab of 28%. Upon that, the cess will be imposed. The GST compensation cess will be imposed. Right? Like the way in which in our above example, the cess is being imposed in such a way, like in this 1 rupee. Similarly, the GST compensation cess will be imposed, and on what goods they will be imposed? These are imposed on those goods which comes under the 28% slab rate of the GST. Particularly, we call them as sin goods and demerit goods or luxury goods. So, upon those items, the GST compensation cess would be levied, and such collected amount with the cess in such, like in our example, like what 1 rupee would be used to fill up this GST compensation fund. See, to put it simply, those goods which comes under the 28% slab rate of the GST are called demerit goods, sin goods, or particularly luxury items. Upon those goods, the GST compensation cess would be levied, and such collected amount would be deposited into the GST compensation fund. Right? I hope it is very clear. Now, what the central government, here you should be very careful, guys. Here what they have said, what the central government said is, how the central government is going to compensate is, the central government is going to take the year 2015 and 2016 as a base year, the year 2015 and 16 as a base year, and they are going to assume that from this particular year, the GST tax collections growth would be 14%, and whatever the collection amount was, we call it as a protected revenue, and whatever the difference between the actual collected revenue and the protected revenue is there, that would be given by the central government out of the GST compensation fund. I hope it is not clear for you with this explanation. Let me give an example so that you can understand it very clearly. See guys, imagine the state of Tamil Nadu. The state of Tamil Nadu in the year 2015 and 16, in the year 2015 and 16, because it's a base year, right, have collected 100 rupees money, 100 rupees as SGST revenue. In the year of 2015-16, the state of Tamil Nadu have collected a state GST, State Goods and Services Tax collection of 100 rupees. Getting my point? This particular Tamil Nadu states in the base year of 2015-16 have collected the SGST 100 rupees. Now, according to the act, it is going to consider the growth in the GST revenue would be 14%. So automatically in 1 year it is 100, automatically if the growth rate is 14%, the next year that particular state should collect 114 rupees of the tax collections. Isn't it or not? This is the meaning of growth rate. See, the next year the state government, Tamil Nadu state government should collect 114 rupees as a tax amount, GST tax amount. See guys, this 14% is not growth rate, not GDP growth rate, state domestic product growth rate. This is not state growth rate. It is the growth in the GST tax collections. Take that base year 2015-16 and consider, see, in that particular year, the state might have accumulated or collected some particular tax revenue, SGST tax revenue, and in the next year, from the next year up to 5 years, the state is going to consider, the central government is going to consider the state would collect the GST taxes with 14% growth rate every year. I hope it is very clear. So, the state of Tamil Nadu in the year 15-16 have collected 100 rupees growth, 100 rupees tax revenue, SGST tax revenue, and the next year they should collect 114. Right? Because the growth rate is going to be assumed at 14%. But unfortunately, see, you know that we have discussed that state have sacrificed the implementation. They sacrificed their power of implementing the different kinds of indirect taxes. As a result of it, and the GST is a destination-based taxation. As a result of it, the GST tax collection would be low. The GST tax collection would be low in the initial phases. Say for example, the Tamil Nadu government have collected in the year 16 and 17, in the next year, the Tamil Nadu government have collected 80 rupees SGST collection of the Tamil Nadu government would be 80 rupees. Now what's the difference between here? So what should be the actual collection? What should be the actual collection? 114. And what is, see, what should be the collected amount? It is 114, but actually they have collected 80. Guys, you have to remember this collected revenue. What should be collected revenue is called protected revenue. These terms are very much important for your UPSC. Protected revenue means if state governments achieves a growth rate of 14% in their tax, GST tax collections, that is called protected revenue. Now this 80 is the actual revenue collected. Actual revenue collected. This is the actual revenue collected. So what is the difference here? So what you observed? The protected revenue with a 14% growth rate should be 114 rupees, but actually they have collected 80. What's the difference between 114 minus 80? So 34. These 34 rupees is given as a compensation to the state government of Tamil Nadu from the GST compensation fund. The 34 rupees would be given to the states out of this GST compensation fund. I hope it is very clear. So in the base year 2015-16, any particular state might have collected some tax, GST, SGST. Now for the next year, for the purpose of providing the GST compensation cess, for the GST compensation amounts to the states, their taxes would be assumed to be growing at 14%. Now that's the same example we have taken. In this particular 15-16 base year, a particular state have collected 100 rupees as a tax. In the next year, we will assume they are going to achieve the tax collection growth of 14%. So automatically they should collect 114. This is called protected revenue. But in actual sense, because of the implementation of the GST, they collected a less tax revenue, less SGST collections. So the difference between these two amount is 34, and that 34 would be given out of this GST compensation fund. This is the procedure. I hope it is very clear for you right now. Now, unfortunately, now what's the issue here? Now, what's the current affair here is, see, try to understand. Now, the state governments should get that money out of the GST compensation fund. Isn't it or not? The central government is not going to give that difference between the protected revenue and the actual revenue to the states out of the budget. It is not giving that amount, the 34 rupees out of the budget. It is not budgetary allocation. The central government will give it out of the GST compensation fund. Now, how the GST compensation is filled up? With the imposition of the GST compensation cess. Now, when the GST compensation cess would be collected? Only when the goods are sold. See guys, try to understand here. During the COVID-19 pandemic, due to the series of the national lockdowns, many of the people have lost the jobs and many factories got shut down. When the people lost the jobs and the factories got shut down, how can we expect the goods and services to be sold? Right? As a result, no goods and services are sold. In fact, many of the essential goods and services given by the government itself to the people. Now, due to these reasons, many goods and services haven't sold like the way once they got sold. So once the goods are not sold at a higher pace, automatically the cess collection would be dropping down. Cess collection would be very low. Now, and to understand, see, try to understand. But the GST compensation act says the states should be given the GST compensation for up to 5 years. Central government have to give it. From where it should give it? It should be given from the GST compensation fund. But the GST compensation fund is not getting filled because the goods are not sold. As a result, the GST cess collection is also very low. Now, what the central government did is, the central government have borrowed about 1.5 lakh crores and 1.1 lakh crores for the first time and 1.5 lakh crores in the second time. They have borrowed the money and they have given it to the states. For 2 years, for these 2 pandemic years, the central government borrowed the money and they have given that particular amount as a GST compensation for the states. It should be actually given from the GST compensation fund. But unfortunately, the GST compensation cess is not more because the goods are not sold during that period. Now, during that period, the central borrowed and have given to the states because the state need to make an expenditure on the health during the pandemic. Now, from 2020, till these 2 years, the central government have paid the interest on it. From 2023 and 24, the central government should start paying the principal amount also, right? They should start also paying the principal amount. Now, what the central government said is, see, the central government said to the states in such a way, imagine it's in such a way. See, we have assured you the GST revenue loss to be paid for up to 5 years. We have paid it. During the pandemic situation, even though the GST cess is not collected, and the GST compensation fund is not filled, as a responsibility, we have borrowed the money and we have given it to you as a GST compensation. Now, from this year, 2023 and 2024, we have to pay back the principal amount. So, we will continue to impose this GST compensation cess till 2026. Now, this cess would be deposited in the GST compensation fund, and we will use that money to pay back the borrowings which we have done to give you. This is what the central government is saying. But states are saying that giving that particular compensation for up to 5 years is not enough. These need to be continued, needs to be extended for some more years. By 2022, the GST compensation fund, see, they have implemented, they have promised in such a way, they are going to, the central government assured in such a way, it is going to be paid up to 5 years only, till 2022. It is for the 5 years up to the implementation of the GST till 2022 itself. This year it is going to get ended. The states are demanding it to extend for a particular period of time. Central government is saying we have borrowed money to give you, so that we will extend, we will continue to impose the GST compensation cess, and we will use that money to pay back the borrowings which we have made to give it to you. Right? I hope this is the current affair, and this is the basics which we have to clear with, and the states are demanding it to be continued. And in the next meeting of the GST Council, see guys, all these decisions would be taken by the GST Council. So in the next meeting of the GST Council, whether the state government is going to get continued GST compensation cess for the longer period of time or not will be decided by that particular council in the next meeting. So I hope you clearly understood all these concepts, guys. So in the previous current newspaper analysis, we have clearly discussed about the GST, how the GST is going to work, what are the direct taxes and indirect taxes implemented, amalgamated in it. So we have clearly discussed about the basics. In this, we have discussed a brief recap of the basics, as well as we have discussed the current affairs in totality, in detail. I hope it is very clear for you. So this is about the GST compensation cess, and all these details that we have discussed here is there. See, I said it has released, it has borrowed, the center has borrowed about 1.1 lakh crores in 2020 and 1.59 lakh crores in 2021, right? To meet the shortfall in the revenue collection. They have paid the interest rate so far from 2023. They have to pay back the principal amount till March 2026. So, although the protected revenue of the state is growing at 14%, the cess collection did not do in the same proportion, because during the COVID-19 pandemic, the goods is not sold. So, the COVID-19 further increased the gap between the protected revenue 114 rupees and the actual revenue collected 80 rupees in our example, right? All these things we have discussed very clearly. Why the center should pay the losses? Because of the GST Compensation Act. These are very much important for you guys. You have to remember it. Now, as I said, the GST compensation cess, the act assumed that the GST revenue of the each state, you have to be very careful here, the GST revenue of the each state would grow at 14%. It is not the GDP growth rate, it is the GST revenue growth rate every year from the amount which is collected in the 2015-16. From the amount collected in 2015-16, 100 rupees, every year the GST revenue would be assumed to be growing at 14%, and that is called protected revenue 114 rupees. And the difference between the actual revenue collected and the protected revenue, that is 34, will be given out of the GST compensation fund, which is filled by imposing the GST compensation cess. Right? It will be given to the states for every 2 months, and it is going to be given for up to 2022. This year, particular year, it is going to get end, and states are demanding it to continue. And we have the GST compensation cess fund that we have discussed. Right? I hope the concept is very clear in its totality. Right, guys? So now let us move to the next topic of this day. Here I have given you the extra information with respect to the GST Council. These are like basics, guys. These are like pure basics. You need to be very careful while discussing about. See, UPSC is going to not only ask the current affairs, but is also going to be asking the statics. It is came into force after the 122nd Constitutional Amendment Bill. The composition of the GST Council, which is headed by the Union Minister, Finance Minister, and Union Minister of the State rank would be a part of it, and all the State Finance Ministers are also part of it, which acts as like a federal body. And see, it is going to provide, it is going to recommend, see, all the laws, rules, each and everything, exemption, which goods should be included in which slab rate, which goods should be exempted from which slab rate, all these type of things would be decided by the GST Council, and these are recommended by the GST Council, but ultimately, remember, notified by the Finance Ministry. GST Council will recommend it, Finance Ministry will notify it. these terms, understanding the difference between these two terms are very much important for UPSC. They are going to say, they are going to put the options in such a way that the GST Council is going to notify all these things. No, Finance Ministry is going to notify things, and this particular GST Council is going to recommend it, right? So this is about it. Next, you need to be these highlighted portions are very much important, and just try to note it down. Recommendations of the GST Council are not binding on the states. This is what the Supreme Court recently said. The court said, like Article 246A, the Constitution gives both Parliament and state legislature the simultaneous power to legislate on the GST. The UPSC prelims options goes in such a way. The states does not have a power to implement. The state does not have a power to legislate on the GST. In such a way, they would give the statements. So it's absolutely wrong. You should be very careful there. Next. So this is about this particular topic, and I hope you clearly understood this topic. Let's move to the next topic of the day. See, the restoration of the trust between the states and center is essential for the GST system. See, author is saying that, see, in this particular news article, the author is saying or talking about the rift that created between the center and states after the implementation of the GST. Just now we have discussed that the state governments have imposed different kinds of indirect taxes like luxury tax, octroi, entry tax, states excise duty, right, sales tax. In such a way, they impose different kinds of indirect taxes once before the implementation of GST. With the imposition of these different kinds of indirect taxes, their own tax revenues is very much high, guys. See, if we talk about the basics, what are the two main sources of the revenue for any particular state government? To any particular state government, the two main sources of the revenue is their own taxes. Their own taxes. Isn't it or not? Their own tax revenue. Their own tax revenue. And another source of the revenue for the government, the state governments, is Finance Commission devolutions. The Finance Commission devolutions. See, for every 5 years, the President of India is going to constitute the Finance Commission, and this Finance Commission is going to recommend how much percentage of the central pool of taxes should be distributed or shared with the state governments. So in such a way, recently the 15th Finance Commission have recommended 41% of the central pool of taxes should be shared with the state governments. Now the states are going to get that amount according to the different census like population, demographic transition. There are various criteria upon which a particular state government will get the Finance Commission devolutions. This is altogether a different topic we will discuss into the next current affairs. But you might have already discussed, you have already learned it about in your polity or your economic classes. See, here we are talking about the Finance Commercial devolutions is the major source, one of the important sources of the revenue for the states. The first important source is their own taxes, own tax revenue. Guys, when we discussed about the basics in our previous economic weekly series, we have discussed what is a tax particularly. To put it simply, tax is nothing but it's a compulsory levy need to be paid by the companies, not by the citizens to the government without any fail. This is the meaning of a tax. Now, when we talked about the type of the taxes, we have two different taxes, direct taxes and indirect taxes. Right? What is a direct tax? If impact of tax and incidence of tax is on a single point, we call it as a direct tax. If impact of tax is incidence of the tax is on multiple points, we call it as indirect tax. So I don't need to explain these things again in this particular session because we have discussed these things very clearly in our previous sessions. So what are the different kinds of direct taxes imposed? See, the state governments imposes different kinds of indirect taxes. Indirect taxes. See, sales tax, VAT, octroi, luxury tax, entry tax, amusement tax, all these are like different kinds of indirect taxes. Now, you have a question, sir, whether the state governments can impose a direct tax or not? Yes, the state governments have the power to impose the direct tax. State governments can also have the power to impose the direct tax according to the constitution. They can impose the tax, income tax on the income of agriculture. So, agricultural income is taxable. The state governments can impose a direct tax on the income of agriculture. But fortunately, many states have exempted imposing the tax on income, agricultural income. So you need to be very careful here. The only direct tax power the only power to impose, one and only direct tax power that is given to the state governments is to impose the taxes on the agricultural income. But fortunately, many of the states have exempted taxing the agricultural income. So when there is an option like the states does not have any power to impose the direct tax, it's absolutely wrong. The states have the power to impose the direct taxes, particularly income tax on the agricultural income, but they have exempted it, right? So this is, you need to be remembering it very carefully. So when we leave this direct tax, the major source of own tax revenues for the states is the indirect taxes. These indirect taxes like nothing but sales tax, VAT, each and everything we have discussed. You also know that all these taxes are amalgamated into the state VAT and then converted into the SGST. So when we talk it simply in a layman language, particularly the two main sources of the revenue for the states is this SGST revenue and finance commission devolutions. So see guys, the states like Andhra Pradesh and some southern states depends, see, out of the total revenue they have generated, the majority of the revenue comes from the own taxes, and a minor portion comes from the central government devolutions. But from some of the northern states, say for example the UP and some Bihar states, the majority of this their revenue collection is through central government devolutions, that is finance commission devolutions. Only a minor part of their total revenue is their own taxes. In such a way, see, in this bar diagrams itself is clearly saying you that for a particular state, their own tax revenue is very high and they depend less on central government devolutions, finance commission devolutions. Like some states like northern states, their own taxes is very low, their own tax collections is very low, and they depend more on the central government, particularly the finance commission devolutions. This is very clear. Now try to understand guys, try to understand. Now the finance commission devolutions is low, particularly for many of the states like developed states, and their own tax revenues is very much high. Now what happened after the implementation of the GST? See, try to understand, out of the total revenue collected, some states like some southern state, developed state like Tamil Nadu, Andhra Pradesh, during that period, out of the total revenue collected, say for example the particular state, this is a state of AP or Tamil Nadu, say for example this particular state, out of the total 100 rupees of the revenue they have, 60 rupees might be out of their own tax collections. For only 40 rupees might be the amount given by the central government. At a particular times, this ratio is about 70 to 30%. In such a way, there are some states in India where they have their own taxes at a large scale, and they have depended they have a less dependence on the central government devolutions. Now this case is when before the implementation of the GST. Now after the implementation of the GST, what happened? You know, just now we have discussed about the current affair that all the states have sacrificed this imposition, the power to impose these kind of different indirect taxes. So as a result of it, they have initially accumulated the losses. That's the reason why the GST compensation fund and GST compensation cess has been initiated, right? So once the GST is being implemented, SGST is implemented, particularly the GST is implemented effective from July 1st, 2017, the state and center got a rift. They are created, the first rift is being created between the center and state during that period, right? Although the GST compensation cess and fund is promised, it is being delayed for a particular days. Now you all know the petroleum products, the alcohol based products are the two particular products for which the GST is not applicable right now. Now what's the meaning of the GST is not applicable right now for these particular products? It simply means these two products are taxed in the same way in which the earlier taxing mechanism is applicable to these tax. For the rest of the goods, it is GST, the way in which the tax is collected, and for these petroleum products and alcohol based products, the old method, the state VAT method, as far as the central government is concerned, the central government, say for example on the petroleum products, we have discussed in the previous newspaper analysis, particularly the Economic Weekly, on the petroleum products, central government is imposing the central excise duty. The state government is imposing the state excise duty, state VAT and each and everything. So what does it mean? So these petroleum products and alcohol based products are taxed in a old way. In a old way means before the implementation of the GST way. Rest of the products are taxed with the GST. Try to understand. So that's the reason why, see, you have observed after the COVID-19 pandemic, what are the first shops that are opened by the state governments? It is nothing but the wine shops, right? You're getting my point. Many state governments have first initially opened the wine shops, because if they open the wine shops, they can impose these kind of indirect taxes, different kinds of indirect taxes on these particular wines, and they can generate the revenue. By generating this revenue, they can use it on the expenditure of the health. They can spend this amount on the health, right? See, if GST is implemented, they would collect a less revenue. If GST is not implemented, they can impose different kinds of indirect taxes. What are the products that the non-GST method is tax collected? These petroleum products and alcohol products. So that's the reason why the states opened the wines, so that they can impose these kind of indirect taxes, so that they can have the enhanced revenue for their spending. So that's the reason they have opened this, right? So this is the reason. So what this author is suggesting it, once the states have sacrificed this implementation of these different kinds of indirect taxes, they lost their tax revenues. They are depending upon the center, particularly the Finance Commission devolutions, to fulfill their constitutional responsibilities. It created a tussle between the center and state, where the constitution itself in the 7th schedule have clearly mentioned on what tax basis center can impose the tax, and what tax basis the states can impose this tax. The constitution have clearly given the power, both the central government and state government, in order to fulfill their responsibilities. What are the responsibilities, guys? National security, communications, all these things are the responsibilities given to the central government. Police, public order, health and welfare, all the different kinds of responsibilities given to the state government. In order to fulfill these responsibilities, both the center and state need money. From where does the money comes from? Money comes through the taxes, right? So in such a way, both impose different kinds of indirect taxes. But unfortunately, after the implementation of the GST, to what level they have expected, they did not generate the revenue. So as a result of it, it initially after the implementation of the GST, it created the tussle between center and states, right? This is what author is suggesting. Complete breakdown of the trust between the center and states. I hope you have understood it. Supreme Court order said that the council decision is not binding on the states. Recently, Supreme Court have come up with this decision. These kind of statements are very much important for your prelims. The lapsing of the revenue guarantee. You know what is the meaning of lapsing of revenue guarantee? Just now we have discussed this current affair. This GST compensation is nothing but lapsing of the revenue guarantee. Lapsing means it is going to end by this particular financial year 2022, which the center had promised the states only for 5 years. Now the states are demanding it for extended period of time, which would be decided in the next GST council meeting. That's how I said in the beginning of the class. So all these are the reasons, the 3 issues that are currently hindering the effective implementation of the GST in the country is these things, right? See, now what author is suggesting, the pandemic has exposed when we look at the rest of the issues, the pandemic has exposed the GST deficiencies. The finance minister invoked the act of God principle to default on the payments on them, which simply means due to the COVID-19 pandemic, the cess is not collected, we cannot pay the GST compensation to that level what we are expecting. But fortunately, with the delay, they got that compensation, but initially with the act of the God, the payments got delayed. The assumption that the easy flow of goods across the country with the implementation of the GST, which would boost the growth, did not work out to be true. The expected growth would be 2% with the GST implementation, with the free flow of goods and services in the country. But even this is not seen in the economy. Economists are viewing it through the prism of efficiency alone. They fail to see what it does to the federalism, where regional parties see that they don't have the power to tax. This is very much important point. It is going to create a tussle between the center and states. When the regional parties particularly, when they identify that they don't have the power to impose different taxes, which the constitution itself have given to them. Right? You are getting my point. Now, when we look at the way forward, what is the solutions? The state should be given the power to impose different kinds of direct taxes. The state should get direct taxation power that they only have currently on agriculture, in agriculture. You have to be very careful here, guys. You have to remember these kind of points. The state should be given the GST compensation guaranteed till the state's economy got recovered. The author is suggesting that there should be no particular 5 years or 6 years or till 2026. The GST compensation should be given to the states till the state's economy got recovered, like the way in which once they use it to collect their revenues before the implementation of the GST. So this is what the way forward given by the author in this particular news article. I hope it is very clear for you. What is the issues and what is the implementation of, or what is the way forward for this particular current affair. So here we have the data with respect to dependency on the center. When we look at the dependency on the center, when we look at this data, see this blue, like this green line particularly indicates central transfers, devolutions plus grants. The red one indicates own non-tax revenue. The blue one, own tax revenue. Particularly leave about this non-tax revenues. There is non-tax revenues. We have discussed these things. What is a tax revenue? What is a non-tax revenue? Right? All these things in our static classes. So the own tax revenue, particularly the indirect taxes through the GST, say for example, for the state of Haryana, see how much is the book line? The Haryana, out of this total 100 percentage, about 60 and 70 percentage is their own tax revenue, and only 10 to 20 percentage is central government devolutions. But on the contrary, like Bihar like states, they are dependent more on the central government devolutions than their own taxes. This is very much important, you need to observe here, right? Now when it comes to the revenue expenditure, just now we are going to discuss the next topic which is very much important for us. See, try to understand. We will discuss and we will use that data too. The topic is states, freebies and cost of the fiscal profit, right? See, these days the state's finances are getting deteriorated. These days the state finances are getting deteriorated, guys. So this is all about that particular news article. See guys, recently we will discuss the topic in its entirety. See, try to understand. First of all, you need to understand the difference between revenue expenditure. You need to understand the difference between revenue expenditure and you need to understand the difference between the capital expenditure. So what is a revenue expenditure? Expenditure means to spend the money. If someone spends the money and if it does not come back directly, all such one-way expenditures are called revenue expenditures. And if somebody spends the money, it creates an asset, and if it generates any periodical revenue, we call it as a capital expenditure. Take the example of salaries and pensions. If once the government pays these salaries and pensions to the people, the state cannot get directly anything in return. So we call them as one-way transactions. All such one-way kind of an expenditure comes under the revenue expenditure, which does not create any kind of revenue for the future, for the government in the future. So once the amount is spent, it is not going to generate any revenue in future. So we call it as a revenue expenditure. On the other hand, capital expenditure is the one, which creates an asset through which the revenue will be generated, and you are going to get some periodic income of it. You take the example, say for example, you have 20 lakhs. You have 20 lakhs of amount with you. And if you spend this 20 lakhs of amount to give a party, to throw a party to your friends, right? We call it as a revenue expenditure because that party is not going to generate any revenue in future. Now instead of that, if you use that 20 lakh rupees to build a house, and if you give it on rent, it is going to generate some periodic income. We call it as a capital expenditure. The party that you do with the 20 lakhs is called revenue expenditure, and the house you built, which is going to give you some periodic payments in future, is called capital expenditure. I hope it is very clear what is the difference between revenue expenditure and capital expenditure. See guys, these days particularly many states are rapidly pursuing the programs of the freebies. Recently, when we look at the Aam Aadmi Party's Mission Punjab, where this particular freebies, particularly this particular Mission Punjab, is going to promise the woman of about 1,000 rupees, and if the family have 3 women, the 3 women is also going to get 1,000 rupees each. I am not taking the side of any particular government. I am not criticizing one, but there are many states, southern states which are aggressively going for this kind of freebies program. Now you know that these freebies, making the expenditure on the freebies is definitely a revenue expenditure. Making the expenditure on these freebies particularly is revenue expenditure, which does not create any kind of a revenue in future, does not generate any kind of a revenue in future. You just understand the data, guys. See, high revenue expenditure, the tagline itself, the data itself is suggesting it's a high revenue expenditure, isn't it or not? See, out of the total expenditure they made, UP is making 82.8% of the revenue expenditure. Kerala is the highest, 90 revenue expenditure. The state of Punjab, Rajasthan, here you see the West Bengal, right? Bihar, all these states, see Andhra, 88% is the revenue expenditure they have done. So in such a way, the states are going for more and more revenue expenditures, and without, see, they are going for more and more revenue expenditures, they are spending less amount for the capital expenditure. As a result, they are not going to create the assets, right? If the assets are not created, they are not going to get the enhanced revenue in the future. See, if a state government spends on more and more capital expenditure, it is going to create some asset, and this asset is going to generate some revenue in future, which thus governments can be used to provide various socio-economic goods like health, education to the people. But unfortunately, the state government is going for more and more revenue expenditure. As a result, no asset will be created and no revenue will be generated. But in order to continue the welfare programs in future and in order to fulfill the constitutional responsibilities, states need revenue, right? But what the state is going to do, as the asset is not created and it is not generating any revenue, when there is no asset, how it will generate the revenue? So when the asset is not created, the states is going to impose or increase the tax burden on our future generations to collect the enhanced revenues, right? If they make the capital expenditure now, it is going to generate revenue in the future which the states can use. If they make revenue expenditure now, they cannot generate any revenue in future, but in order to enhance the tax revenues, they are going to impose more and more taxes on our future generations, which is a great problem, right, for the states. Now, try to understand. These days, the states are pursuing more and more these kind of programs. Now, you may have a doubt that, try to understand. Now, imagine what the situation is, try to understand what the current scenario is. Now, if the government wants to make an expenditure of 100 rupees, if they get a revenue of only 97 rupees, the balance 3 rupees is nothing but deficit. Now, this deficit amount is borrowed by the government. We have discussed about the government borrowing program, what is internal borrowing, what is external borrowing very detailedly in our previous classes, particularly the newspaper analysis classes. Now, once the government borrows this money, the government is also using this money, most of this money, as a revenue expenditure. You might have a doubt, now, in such a way, the government, although the current amount, in such a way, they are making 100 rupees, they are getting 100 rupees. Out of this 100 rupees, 90% is the revenue expenditure. In such a way, even the borrowed money is going for the revenue expenditure. This is the main concern, this is the grave concern here. Now, you might have a doubt, sir, what is the checking mechanisms? Can't we stop this kind of revenue expenditure? Can't we stop this kind of freebies? What is the checking mechanism, right? See, try to understand, guys. The main act that we currently have is FRBM Act, Fiscal Responsibility and Budget Management Act. This act limits the fiscal deficits of the states to 3% of GDP, right? 3% of the GDP. But see, try to understand. However, the states are borrowing more and more money and they are making it as expenditure. But try to understand, these days, the states are going for more and more off-budget borrowings. See, try to understand. Let me give an example. See, try to understand this example. I am going to give it to you in a oral way. Imagine, try to understand. The FRBM Act calculates the borrowings of the central government which are mentioned in the budget books only. They are not going to track the off-budget borrowings. Now, try to understand. See, imagine the Food Corporation of India. It is a public sector undertaking. See, Food Corporation of India. See, understand, it's a public sector undertaking. Imagine, for the public sector undertaking FCI, the central government have to pay 100 rupees as a food subsidy. We have discussed in the agriculture chapter what is central government food subsidy, what is state government food subsidy. Central government food subsidy is nothing but economic cost of food grains of the FCI minus central issue price. We have discussed about it very clearly in our agriculture chapter, in the Indian economy particularly. So, the central government have to pay 100 rupees as a food subsidy for the FCI, right? Now, try to understand. If the central government borrows 100 rupees and if they mention it in the budget books that they are borrowing 100 rupees, they are definitely going to breach the target of 3% fiscal deficits. Because see, the accumulated borrowings, the borrowings made by the central government at the end of the financial year is nothing but the fiscal deficits. So if they borrow this 100 rupees, they are going to say for example, if they borrow this 100 rupees, they are going to breach the fiscal deficit target of 3%. Now what they are going to do is, they will mention that in the budget books they have borrowed only 50 rupees, so that their fiscal deficit will be remaining below 3% of the GDP. But however, this 50 rupees will be given by the central government to the FCA, but actually they have to give it 100 rupees. Now what the central government do is, under the directions of the central government, the FCA is going to get the 50 rupees as a loan amount. Right? We call it as off-budget borrowings. Off-budget borrowings are those borrowings are those kind of a borrowings which are not done by the central government. To put it simply in a layman language, these are the borrowings which are made by the PSUs. Right? Try to understand. But the FRBM Acts calculate only those borrowings in the fiscal deficits which are made by the center. Right? So in such a way, this 50 rupees does not come under the calculation of the fiscal deficit. So in such a way, the states are escaping this FRBM limits, FRBM targets. In such a way, whatever the audit report it is, whatever the calculation it is, whenever we look at the finances of the states, their fiscal deficits are well within the ambit of the FRBM target. How it is possible? It is mainly possible because of these kind of off-budget borrowings, where the borrowings made by the public sector undertakings are not calculated in the definition, or not calculated for the purpose of fiscal deficits. So this is how they are escaping the net. So more, try to understand, this is the off-budget borrowings are not calculated for the purpose of a fiscal deficit, not calculated in the fiscal deficits. This is not only the case. The second one is, those borrowings made by the states for which the states does not extend any kind of explicit guarantee is also not calculated on the fiscal deficits. So these two gaps in the Fiscal Responsibility and Budget Management Act, allowing the states the both off-budget liabilities and those borrowings which are made by the state for which the states are not given explicit guarantee. So these kind of borrowings are not calculated in the fiscal deficits. As a result, the state seems to be well within the ambit of the fiscal deficit limits. But on the other hand, when we look at the broad picture, when we zoom out the things, what the state governments are doing, they are showing the less kind of borrowings in the budget books, so that they will be well within the FRBM limits, right? On the other hand, they are going for off-budget borrowings. They are borrowing the money and making these money to provide the freebies. The main problem is, these freebies are being sponsored by the off-budget liabilities these days. How are they sponsoring it? Because see, that's the main mechanism. FRBM Act is the main mechanism to check this, but unfortunately they have the gaps. They are not going to calculate the off-budget borrowings. See, they are not going to calculate the off-budget. Say for example, if government of India have borrowed 10 rupees, guys, the government of India borrowed 10 rupees, and understand, out of these 10 rupees, they in the government of India have borrowed 10 rupees totally. They have borrowed 5 rupees internally by issuing the government securities. They have borrowed, see, the public sector undertakings of the central government have borrowed 3 rupees, and the government have borrowed another 2 rupees for which they haven't given guarantee. They haven't given any kind of explicit guarantee. Now for the purpose of fiscal deficit, now you can tell me, what is the fiscal deficit? Now the fiscal deficit is only 5 rupees. Now fiscal deficit is only 5 rupees, because they are not going to calculate this off-budget liabilities, and they are also not going to calculate those borrowings which are taken by the governments, for which they are not given any explicit guarantee. So due to these gaps, it seems to us that the central government, the state governments are well within the FRBM limits, but on the other hand, with the off-budget liabilities money, they are going for their freebies. So the first checking mechanism, the FRBM Act, have its loopholes. So it need to be plugged. Now what is the second mechanism that can be taken, that should be checking these freebies of the state governments and checking the revenue expenditure, more and revenue expenditure of the state governments? It is the oppositions. The opposition should play the democratic role in questioning the government and limiting their revenue expenditure, so that more and more capital expenditure would be done by the current state governments, which would not pose any kind of a tax revenue burden on the future generations. But unfortunately, due to the fear of the vote bank, even the opposition parties is not fulfilling their democratic responsibilities on the floor. Okay? The third mechanism which should be stopping this is the CAG report. Comptroller and Auditor General's report. You all know that in your polity classes you might have studied that the CAG report The CAG report particularly comes much later once all the expenditure is done. Its report is like, see, often the CAG report is criticized in such a way. The report comes in coffin with the nails tightened. Right? So in such a way, by the time the CAG report comes, it lost its relevance. So the main mechanism, FRBM Act, is loopholes. The opposition party is not playing its own role, and the CAG is also not playing. Even though the CAG audit comes, it lost its revenue by the time it comes. So these are the checking mechanisms which should be given, which should be checking these kind of freebies. Guys, here you need to remember, nobody is denying the fact that the state should not go for revenue expenditure. A certain level of revenue expenditure is very much important for the purpose of transfer payments. What is the transfer payments? Like one-way payments which are done by the government, like revenue, salaries, pensions, all these. Salaries. Take the example of a age-old person or a vulnerable section person. Supporting him with the transfer payments, like you have an age-old person, give him the pension, it's a transfer payment, it's a revenue expenditure. Such kind of a revenue expenditure to a certain level is accepted. But 80%, 90% level of revenue expenditure is not at all accepted, which is going to impact our future generations. So it should not be happening, right? Now, what is the way forward? We should amend. So what is the way forward? Amending the FRBM Act so that both the off-budget liabilities as well as those borrowings for which the state government does not give explicit guarantee, these two should be considered while calculating the fiscal deficits, right? This should be the way forward. The second one is, see, you need to understand here, when states, when we discussed in the economic classes that states does not have the power to borrow from outside the economy. Only the central government is allowed to borrow both internally and externally by the constitution, but the states are not allowed. See, for example, if state government still owes debt to the central government, imagine myself as a state government, if I have taken some borrowings from the central government and I haven't paid it completely, but still I want to go for more and more borrowings. So if state government still owes a debt to the central government, and if they want to go for more borrowings, they have to take the permission from the central government. The central government should use this as this opportunity to impose some conditionalities, on reducing the revenue expenditures of the state governments. This is with the second way forward. And the third way forward, which that other particularly suggested in that particular news article, is to impose the financial emergency. He said that if the state's finances is deteriorating in such a way, the financial emergency should be imposed. It is there for a reason in the constitution. You need to remember, guys, COG report said that during 2019, the budgetary borrowings is almost equal to the off-budget borrowings. See, as far as in order to calculate the off-budget borrowings of the government, there is no accessible data. There is no particular data which gives us that what is the level of off-budget liabilities. But the COG report said that it is almost equal to the budgetary borrowings. And second more important point, see, often we are concerned about the fiscal deficits of the central government. You need to remember, the states altogether will borrow the equivalent amount of the money that central government borrows. So to that level, the state government's combined borrowings will be there. So you should be very careful. See, even in fact makes the relevance that state finances are very much important for the macroeconomic stability of the economy. So these should be the way forwards which would be implementing so that the state finances would be recovered after a period of time, and it moves towards the path of going for more and more capital expenditure, which does not impact the macroeconomic stability as well as our future generations. This is what others have suggested, and we have all these things mentioned in this particular thing in detail. You can just pause it and you can note it very carefully. You can note all these points. These are like very much important, like opposition should play a role. Under the constitution, state is required to take the center's permission to borrow. The center should not hesitate to impose the conditionalities. Imposing the financial emergency, it is there for a reason. And the important one is the FRBM Act, right? FRBM Act. All these things need to be amended. So this is like about the important article. Guys, today we have discussed about very important articles with respect to economy. Guys, this class is very much important. Listen to this class once or twice and try to write all these perspectives in your notebook. I hope you clearly understood it, right? So this is about this week's economic current affairs, and in the next week also we are going to have some important current affairs, which is nothing but the continuation of these topics, right? The news will be in transition, they are going to get continued for a while. So this weekly session and as well as the next economic weekly session is going to be very important as far as the UPSC is concerned. So just listen to this class once or twice, try to develop the perspectives, try to note them down and have a good knowledge, right? So this is about this week's economic weekly. Thank you and stay tuned to Rathods IAS.